It's tax time again, which means for the 6th year in a row, I'm back with my Maximize Your Tax Return video. I did over 1,000 tax returns last year in my business Rooshock accounting, so I think I'm in the lucky position where I know a thing or two about getting the most out of one. By the end of this video, you'll know 6 specific ATO-compliant strategies that you can use to help maximize your 25-26 tax return. And the great thing is most of them will take you less than 10 minutes to put into place before you hit lodge. Let's start with one of the deductions that is actually probably one of the most common deductions that people are eligible to claim, but also one that people forget to claim, and that is your motor vehicle expenses. If you use your vehicle for work-related purposes, then you will be eligible to claim a deduction in your return. But let's first get an understanding of what's actually claimable and what's not claimable. So you can claim your vehicle when you're using it for work-related purposes, but what is work-related purposes? Well, this is going to be trips once you're at your workplace. So you arrive at your workplace and then you have to use your vehicle to go visit a client, or maybe you have to go and visit a supplier, or maybe you're traveling to a conference, or maybe you're just traveling between worksite A and then you've got to go to worksite B. These are normally going to be claimable. But what's not claimable? Well, what's not claimable is unfortunately the most common trip that we make for work purposes, and that is going from our house to our work. That is deemed as private in nature, a bit bizarre, but it is not claimable. So you cannot claim for work-related kilometers just driving to work. Now there are some exceptions to this, such as if you're carrying bulky tools. This is a complex area that you need to make sure you get right, so go onto the ATO website and read about this to see if you're eligible. But once we determine this trip is eligible, how do we claim for it? And there are 2 main methods. We have the cents per kilometer method and the logbook method. So the cents per kilometer is definitely the most common method that people would use because it's the easiest to calculate and it's the one you require the least amount of record keeping for. And it's as simple as what the name says. You're claiming a certain rate of cents per kilometer that you travel. The first thing, of course, that you'll need to calculate is, well, how many work-related kilometers have I actually traveled? And this can be done, maybe you keep a bit of a log of this, or maybe you know the distances between places and you know how many times you've done it, but somehow work out how many kilometers have actually done. Go back through your calendar, back through your timesheets, or back through any kind of events. Maybe you've got in your emails that you did a conference and you go, yes, I did drive to that one. Get that idea of how many kilometers you've done. Then, of course, once you've got kilometers, you can work out what the rate is. So the rate for 25-26 hasn't changed, unfortunately. It's 88 cents per kilometer. And you need to understand the maximum claim you can make is 5,000 kilometers. So in a world where you have traveled 5,000 or more kilometers for work-related purposes, your maximum claim will be 5,000 kilometers at 88 cents, which gives you a claim of $4,400. For those of you that are on the 32-cent tax bracket, that's a refund or a reduction in your tax of $1,408. Now you do need to be careful. Just because the maximum is 5,000 kilometers doesn't mean you can just claim 5,000 kilometers. You still need to have actually traveled the 5,000 kilometers to be able to claim for this. Now the other method is the logbook method. Now this one is much more complex because you need to do a logbook for a 12-week period. Now this should be a representation of a regular period of travel for you, and that logbook must contain where you went and how many kilometers it was and whether it was personal or business or work related. So you can then work out what percentage of my travel is private and what percentage is work related. This will give you your work related percentage of your motor vehicle. Then you claim that percentage of all of the actual costs. So we go through and look at our fuel, our registrations, our repairs, our insurances, and potentially depreciation and interest. And then we work out maybe our total running cost of our car is $10,000 and our car was being used 60% of the time for work related purposes. So we have a claim of $6,000. And in that exact situation where you traveled over 5,000 kilometers and that was your actual cost and that was the actual percentage, then the logbook method would be better for you. But you could be in that same situation where the kilometers are over $5,000, but maybe your work-related percentage was only 30%. So that 30% at the $10,000 of cost would only get you a claim of $3,000. Well, in that case, if you've done over the 5,000 Ks, you'd be better to use the cents per kilometer method. And that's a great thing with the motor vehicle expenses. You can pick the method that maximizes your return. One other area where people go wrong with this, and hopefully by me telling this will help you maximize your return, is understanding that just because you get paid an allowance doesn't mean you can't claim a deduction. An allowance for motor vehicle typically comes in as income, so you're going to be taxed on this income. So of course you do want to claim the relevant deduction that relates to this. Now it's different if you get reimbursed. So if you get reimbursed for your expenses, you can't claim. But just because you get allowance doesn't mean you can't claim a deduction. In fact, it's even more important to claim that deduction. Let's move on to another area of traveling, and that is travel expenses. So we've talked about the motor vehicle side of things, but what about the other costs that go into travel? So work-related travel costs include all of these different areas. Let's have a look at them. So we've got things such as flights, trains, taxis, rideshare, public transport, car hire, accommodation, meals, and incidentals. So we've got a lot of different categories there that could be claimed. but we need to understand a little bit about when we can claim and what kind of record keeping we would need to keep. The first thing is the golden rule of any deductions, and it's meeting these 3 rules. So we need to make sure that we actually spent the money and we weren't reimbursed. It was directly related to earning our income, and we have a record to prove that it happened, normally a receipt. But with travel, there's a few other rules that you need to make sure you're meeting to make sure you're eligible to claim the deduction. So if you're wanting to claim travel expenses, you need to also be doing these things. So you need to make sure that the travel is being apportioned if it is private versus business or work related. We need to keep a travel diary if it is over 6 days, and we need to make sure we keep these records for 5 years. So we want to make sure we're ticking those boxes if we're going to be claiming under travel expenses. There are also strict rules on what kind of travel you can actually claim. So most of the time, when I'm talking about travel, I'm talking about overnight travel. So you're required to travel out of town or travel away and you're staying overnight. Now there is differences then if this becomes more of a permanent basis, so you need to make sure you understand those rules. But in general, if we're traveling overnight, maybe we're going to a conference for 2 nights, then yes, we are able to claim these expenses. What we need to be careful of, and where a lot of people go wrong and they don't maximize their return, is they go, oh, my employer paid for some of it, so I'm not going to claim anything. But you can still claim the things that you paid for. So maybe you go to a conference and the conference ticket is covered. Your employer pays for that. They also pay for your flights and accommodation. But when you get there, you had to catch ride shares. You were catching Ubers from the airport to the conference. And while there, you had to cover all your own food and drink. Well, then you can still claim for those costs. Of course, you can't claim for the flights and accommodation and the conference because you didn't pay for them. But you can definitely claim for the things that you actually paid for. Now, of course, you need to be careful if there is a private portion to this. Maybe it is a trip where you had to pay for everything, but the first half of the trip you were there for work purposes and then you stayed another 3 nights, for instance, for a private holiday. Well, we need to make sure we are portioning those things correctly. This would also be the same if maybe you've traveled but you've brought your spouse or your children with you, and yes, there was a work-related portion to the trip, but of course you can't claim for their costs. It's a little bit complex for this video, but when you're talking about food and drinks, understand what are the reasonable allowances for this when it comes to traveling, understand how you could use that to help maximize your return. But of course, I did just mention the word maximize your return. I've mentioned a lot through this video, but one way you could do that is to use my business, Rooshock Accounting. Like I said, we did over 1,000 individual tax returns last year. We're going to be doing 1,000 more this year and hopefully more again. And I'd love to be able to help you if you need help with your return, no matter whether it's just a standard return or maybe you've got some complexity such as investment properties, crypto, or maybe you've even got a business. We'd love to help you. The link to our website is in the description of this video. But let's jump back into the video and let's talk about number 3, and that is don't lodge too early. Now, a lot of people want to get their return lodged because they want to get their refund, and I understand that, but lodging early doesn't mean that you get more of a refund, or even sometimes doesn't even mean you get your refund first. In fact, quite often those that lodge really early actually could have their refund delayed. And here's why. The ATO expects your return to be lodged correctly, and when you lodge early, it runs the risk that it isn't correct. And that is because things might not be ready. So if you lodge your tax return and your income hasn't been made tax ready, and your employer goes and makes it tax ready, and they've modified the numbers compared to what you lodged, and the ATO hasn't processed it, now we've got a data matching area where it says you earned this much on your return, but you actually earned this much based on what was reported, your return's going to be held up. So one of 2 things would happen. You either lodge early and the ATO holds up the processing, because between the time you press lodge and the time that the ATO process it, new information becomes available, and now they need to re-verify with you, well, what is actually correct. Or the second thing happens, they process that refund. Maybe you're getting $1,000 back, but then they discover you actually had some more income. So maybe it was some interest income that got omitted. And now they go, well, now we need to adjust. And you should have only got $800 back. Now you owe us $200 and you get a bill. And no one loves to get money and then be told you've got to pay that back. So what are the common things that could go wrong that you could look out for, that if you are planning on lodging early, that you can get correct so you don't have to worry about it? Well, I already talked about, is your income being made tax ready? You need to make it until it says tax ready from your employer before you can do it. They report every single pay run. So now we have something called single touch payroll, STP, and each time you get paid, they report this income to the ATO. But they need to finalize this. And too often we pick up new clients that have businesses that have employees and they aren't reporting the correct information ongoing. We have to help them fix it to get it right. So you need to make sure you wait until it says tax ready before you lodge. The other most common area is something like interest income. The banks don't always report this on the 1st of July. Sometimes it takes a few weeks for this to happen. And because interest rates have been higher over the last few years, people have earned that little bit more interest income. And even $1,000 of income on interest, if you're at the tax bracket of 32 cents, that's still $320 difference in your return. So you need to wait till that income is either pre-filled onto your return or get that information from your bank and add it into your return manually. And this is the same for things like dividends. And dividends could be one where you're actually missing out because maybe you've got dividends that had a franking credit and you're on a lower rate than what the franking credit rate was. You actually could be increasing your return by including these dividends. So knowing what actually needs to go into your return will help you avoid the situation where, yeah, you maximize your return incorrectly and now you owe ATO money. Now the next section is talking about private health, the Medicare levy surcharge, and it actually links quite heavily back into that last one. And that is because quite often your private health details aren't pre-filled in the really early stages of July. Now for some people this will make no difference because maybe they've been getting the correct rebates along the way, their income is in the right bracket, they're not having Medicare levy surcharge issues, and therefore it actually didn't make much difference. But for some people, this could mean your return is wrong. If you've been getting the rebates at the wrong amount, maybe you're in the wrong tier, and if you're in a tier that's below and you've been overclaiming your rebates, you actually would have owed some money, or maybe you've been underclaiming the rebates and you actually would get some money back. But the big area where it's going to cause issues is the Medicare levy surcharge. So for those that aren't aware, you will pay the Medicare levy surcharge if you are over the Medicare levy surcharge thresholds. So you see here on screen is $101,000 for singles and $202,000 for families. So if you are over this amount and you don't hold hospital private health cover, you will pay the surcharge. If you do hold hospital private health cover, you won't pay the surcharge. So you can see by lodging your return early and not having this information in there, you could get this wrong. So if we have a look at the example here of someone who earns $110,000 and they do hold private health hospital cover. So they would have to pay the Medicare levy surcharge, but they don't because they've got that cover. But this person, they rushed off. They wanted to lodge their return on the 1st of July and they forgot about this. They didn't include the private health details because they hadn't pre-filled. So unfortunately, they've had to say, no, I don't have cover. And therefore, they're going to get charged a surcharge of $1,100. Now, they actually shouldn't have to pay this. But do you think the ATO is going to contact you and say, we just realized you did have cover, you got that wrong? Probably not. So you want to make sure if you have cover and you're over that, you are putting that detail into your tax return. Now, of course, you can't go back and fix if you didn't have cover for last year, but we're right at the start of July right now. So if you are going to be over that threshold and you don't have cover, just go and get a quote. At least you can compare how much would the surcharge be, how much would the hospital cover be, and what is the real cost or potential savings to me between the two. Now, it couldn't be a maximize your tax return video without talking about work from home claims. And this, I would say, is in the top 3 claims that people make. And the ATO are aware of this and they know how many people are getting it wrong, and it is on their hit list. Now, again, for this year, we have 2 methods to choose from. We have the fixed rate method and the actual cost method. Now, the fixed rate method, that is way more common because it is a simple method and a lot of people are finally using it. And it's getting a similar claim quite often with way less record keeping. Unfortunately, the fixed rate method hasn't changed. It's still 70 cents per hour at the time of recording. Now, of course, always check the ATO website for up-to-date details, but it requires you to know how many hours did I work from home, what is the fixed rate, and let's work out our claim from there. Now, the hours, it is actually one where you do need to keep track of all the hours. The ATO did have a different method a few years ago where you could average it out. They have removed that, so you need to know how many exact hours you did. So don't just go, oh, I worked approximately 20 hours per week from home. We want to know, I worked 1,200 hours from home. That is a much better thing that if you get an audit, that's what the ATO expect. The good thing is, if you haven't been doing this along the way, you probably can work that out from timesheets and your calendar to have a bit of an idea of how many hours I worked. But of course, put a method in place next year so you know exactly. But it is very simple. You might have said, I did work 1,000 hours from home during the year, 70 cents, here's my $700 claim. But what is not so simple is making sure you understand what that claim actually includes, because what you don't want to do is either claim things that are already included in the fixed rate, or more importantly, miss out on things you could have claimed in addition to the fixed rate. So the fixed rate, as you'll see here, it includes home and mobile internet or data expenses, mobile and home phone usage expenses, electricity and gas and energy expenses, and stationary and computer consumables such as printer, ink, and paper. So that is what the fixed rate includes. So you cannot claim any of these expenses in addition to the fixed rate. So this is where a lot of people go wrong, is they want to claim the fixed rate, they want to claim the hours at that rate, and then they also try and claim for their phone. For instance, you cannot do this. Now, before I touch on what else you can claim, let's quickly look at the actual cost method. Now, the actual cost method is pretty much what it says. You're going to claim the actual work-related costs of these. So those items I just listed off, you can now claim those costs, but your actual work-related percentages. Now, some of them are going to be really easy, like the consumables, because we're actually going to have a receipt and we know the amount. So we maybe spent $200 on printing ink. Yeah, we can claim that. Others are obviously much more difficult. Your phone and your internet and your electricity costs, because you're only allowed to claim the work-related percentage of these. For an internet, you're going to have to come up with some kind of log to show what percentage is actually work-related. And for electricity, you're going to have to show what items am I using, what rates of electricity am I paying, and how many hours did I use them for. A lot more complex, and a lot of people choose to go, you know what, too hard basket, let's do the fixed rate. And from my experience of what I've seen, I think the actual cost can work out better in some situations, but quite often the fixed rate is actually quite competitive, and the simplicity is where a lot of people lean. Now, what you need to know though is what is not included, and it is the depreciation on equipment. So you can claim that in addition to the fixed rate or the actual cost. And a lot of this is going to be things like laptops, monitors, computers, chairs, desks. And you can claim these over a number of years. It's going to depend on the item as to how many years they're claimed over. A lot of your electronics are going to claim quicker than, for instance, furniture. Where people also go wrong with this area and where they fail to maximize their return is if they're switching between agents and not letting the new agent know there could be existing claims, or having a poor agent that doesn't ask you about this, or if they're switching between doing the return themselves and going to an agent, or maybe they've gone from an agent back to doing it themselves. Because these claims are normally in your return and they roll forward. So for instance, we do a client's return this year and then we do it again next year and they had a claim in year 1, the depreciation is going to roll forward to year 2 and we know what to claim in year 2. But if you switch between agents or switch between doing it yourself and the ATO, these things don't happen. They don't attach to yourself, so you need to bring them in with their proper opening values. And then number 6 is actually an area I don't even know if I've ever talked about across 300 plus videos on this channel, and it's subscriptions. So subscriptions could mean lots of different things. Maybe they're like union fees or professional memberships, maybe it's software, or maybe it's some kind of online subscription you pay for. And these are all going to be claimable if they're work related. Now, a lot of these are going to be 100% work claimable because they're completely related to work. And union fees, or maybe it's a professional body fee. There are some that could be used for a split. Maybe you subscribe to something like Canva and you use it a little bit personally, but you also use it as part of your job. Well, of course, you'd have to apportion that, but definitely don't miss out on that claim because you're using it for work-related purposes. And this is an area I've seen grow a lot over the last number of years with things like AI coming into the play. Because a lot of people might go, you know what, I want to learn AI, I'm going to use it as a part of my role. Work isn't paying for it, but I'm going to pay for a ChatGPT subscription. I'm going to pay for a Claude subscription. I'm going to pay for extra credits, especially if you're using something like Claude and you're using it a lot. Make sure you're claiming this if you're using it for work-related purposes because these things add up. One of the other things to remember in these areas is quite often these are charged to you in a currency that isn't Australian dollars. You need to convert it back to Australian dollars, but quite often a lot of these things are in US dollars and our exchange rate means that what you paid in US dollars was going to be more in Australian dollars, so make sure you're claiming the correct amounts here. You're probably also wondering, well, what has actually changed between what I did in the 24-25 return and the 25-26 return? Well, of course, I've got you covered in this upcoming video where I go through the key changes that have happened for 25-26 returns. As I mentioned before, thank you for watching, and if you need help with your return, make sure you reach out to us.